Hey, what's up, good people? Welcome back to Stock Up with Larry Jones. You guys already know, before we get started, hit the like, subscribe, and the notification bell. I have a special guest today, but before I bring him on, I want to say do not fall for spam in the comment sections. Never send money or crypto to anyone on anyone's pages. Anything myself or my guest should say is not a suggestion for you to buy, hold, or sell, but we're going to discuss something very important. Could you guys show some, there we go, some thumbs up for my guest, Mr. Stock Curry. What's up, Curry?
Hey, how you doing, Larry Jones? Great
I'm
to
doing
see you.
well.
Great to be on your channel, Uncle Larry. Great to be with the Stock Up family today.
That's cool, man. That's cool. Good to have you on. And let me make sure, let me cut you up a little bit more so I can hear you. There we go. All right, all right, all right. It's been a crazy day in the market. I like to open up by acknowledging people in the house. Stock Curry is the man. Man, your fans are already here. Look at that. Look at that. They are already here. Hey, Ash, how you guys doing? How you guys doing around the world? How you guys doing? All right, Mark Miller, love Stock Curry info. Look at that. Look at that. Man, they showing you love already.
Yeah, man. Hey, if you're a subscriber of my channel, put some curries in the chat.
Here we go. Here we go. Okay, that's cool. That's cool. Yeah. This has been a long time coming. I reached out to Stock Curry. Didn't I shout you out in one of my videos on YouTubers to know?
You have. You've been shouting me out for over a year now. A large number of my subscribers have come from you, so I just cannot thank you enough, Uncle Larry, for your support of my channel over the past year. You've been an incredible blessing.
Hey man, hey, this is what this is all about, man. I only look at you because you know what you're doing. I only listen to you because you know what you're doing, and a lot of times the bigger pages, sometimes should I say the smaller pages, are where you can get the most value from, as far as information. And then I just came across your page one day, and I listened to you, and I'm like, this guy is sharp. He knows what he's talking about. So, hey, here we are. Yep. Hey, what about today's market, man? Let's just start with that. I mean,
Man,
everybody's wondering, is the bounce back over already?
I got to tell you, the technicals are extremely bearish.
Yeah.
This, as you know, this is the worst start to the stock market in history. Never in history before have we ever had a worse start to the year.
Right.
And I did a whole video yesterday on my channel, about an hour long, just going through the history of the stock market and going through the technicals, the psychology, and showing people, what they can expect for the stock market over the next year or so. And I got to tell you, it's pretty bleak. As bad as it has been over the past 4 months, I hate to say it, but it looks like it's going to get even worse.
Absolutely. I 100% agree. I've been having asking people to just kind of not do a lot of dip buying, but just kind of cash up right now. I've been saying since last quarter, I moved into 70% cash, and I'm still 70% cash. Just like a lot of people, there's some plays that I'm in. Some I'm flat, some I'm red. I got stuck in, but those I'm not worried about because I'm not in a lot of hype stock, that type of deal. I'm into companies that I believe in for long-term growth. And so, I mean, this is some of the stuff that we have to look at. What you got to say to that?
Yeah, absolutely. I'm in the same boat. I'm mostly cash right now, just like you are. I do have a very small trading account that we are working through. I've been blessed enough to tell everybody I've been up in that trading account, but unfortunately today we turned just a little bit negative, but we'll get it back. And as far as the long-term portfolios, kind of depends on what I'm in. I got some that I'm up on, some that I'm down on. But like you said, it's very stock dependent. The good news, I do see some hope, though. There is hope for the future.
Yes.
If you look at the history of how the stock market normally trades during a mid-year election year, typically it will bottom out around October, and then November and December are bull months for the stock market. So certainly there's hope towards the end of the year that we'll bottom out around October. And then the other thing that a lot of people don't understand, I think it's real important to understand this, is the small caps do not trade along with the overall market. The market indices are determined by the large cap stocks. So just like last year in April onward, really for the past 12 months now, we've seen small caps go down and down and down and down, get absolutely obliterated, with many of them down 90%. And yet the market indices from April through the end of the year last year went up. And a lot of people got really confused by that. Well, the reason is because small caps are usually your leading indicator for what the stock market's going to do 6 months from now. And I'm really excited to see small caps rising even as the overall market goes down.
Yes.
Small caps are the best performing right now. And that is a lead indicator that maybe about 6 months from now, we're going to see the overall market start to come up. So in the same way you wanted to be selling out of all the small caps in April last year, now you want to be buying them because they're going to go up even as the overall market goes down.
Could you explain to people what small cap stocks are for those newbies?
Absolutely. So small caps, everybody's got their own definition. Generally speaking, your small cap be anything under $1 billion market cap. But everybody's got their own definitions. A lot of people get confused by price, and they think just because the price is low, that makes it a small cap. It's not. You really have to look at market cap. You know, most of the stocks that YouTubers talked about all last year, they're all small caps. They're all high growth stocks. They all got obliterated. But the good news is they're now starting to go up. And I am seeing stocks go up today, even as the market was down 5%. So definitely all those stocks you were just obliterated on, you know, those are the ones that you might want to start buying back into right now and start dollar cost averaging into.
I 100% agree. Listen, Stock Curry and myself know that it doesn't matter what market you're in. You can actually make money in any market. I've made it. He has also. During a bear market, during a recession, a correction, you just have to know a thing called rotation. You have to know what stock to be in and what sectors to be in. And you also have to know when to get out of those. Like oil and energy, for instance. Energy is running high right now, right? Me personally, you guys know, I shared it with you guys. I sold all of mine when oil got to 130. Now, there's signs showing that oil is just going to, be a banger for the rest of the year. But I just got out when oil hit, not natural gas, but when oil hit $130 a barrel, right? But in that same instant, if inflation peaks at the same time, the geopolitical stuff, let's just say Russia says, hey, we've done all we're going to do, we're going to call this victory and pull out, then you're going to see it start to come down very quickly. What do you think about that?
Yeah, I agree. It's really, really difficult to predict future inflation. Obviously, the Fed is saying they think it's topped out. It's going to start going down. But then again, the Fed was saying it was transitory last year and it would start going back down. And it
for a whole year.
Who knows, right?
Yeah.
I mean, economists have been proven wrong so many times over the past year that, I'd say take anything they say with a grain of salt.
That's true.
Inflation, I will tell you that inflation is always done year over year. So, last year we were comping against deflation in 2020. This year we're going to be comping against pretty high inflation from 2021. So certainly it's going to be very difficult for inflation to rise. But what we saw the last time inflation was rising this high back in 1973 and 74 is we saw inflation rise up, get up to about 10, 11%. And then it started dropping. It dropped all the way down about 5% back in, again, 73, 74, because it was comping against, that super high 10, 11% inflation from the year prior. And then in 1975, inflation started going up again because it was suddenly comping against 5% inflation. So It's very possible that what we could end up seeing this time around is in 2022, inflation, well, the rate of inflation starts to go down because we're comping against very high inflation from last year. And then come 2023 or 2024, we see inflation start to rise up again because we start comping against lower inflation. So the real number you have to look at is forget about year over year inflation and look at the month to month increase. That's going to give you the actual numbers of inflation without getting confused about these year over year comps, because the year over year could look good, but the month over month is really going to tell you the true story of what's going on.
Yeah. Someone said they're getting a small echo. I don't hear it. Let me try. Hear me, Curry?
Are you getting echo from me?
Yeah. Can you hear me clearly now?
I can hear you clearly. Yes.
Okay. I hit an echo button. Let's see. Can you guys still hear an echo from Curry? Let me know yes or no. Say something, Curry.
Something.
Any echo? All right, I'll just leave it select until it changes. All right.
All right, sounds good.
You should have an echo cancel. Hit that. Okay. You know what? Let's take a station break right now. Listen, there's 13. I'll say it says good now. All right. So hey, there's 1,300, almost 1,400 people watching, and we only have 382 likes. Good people. Come on. I thank you. Do that. Yes. Could you guys do us a favor? And we're going to talk about the mortgage crisis. Could you guys right now hit that like button? We need to get those likes up over 1,000. If there's 1,300 watching, we should have 1,300 likes. All right. So let's go ahead and hit that. Let me hit refresh. Everybody, there we go. We're coming up now. 400. Come on. Can we get 500? Can we get 600? All right. So let's say thank you. Yeah, no echo now. Let's get right into the housing market as they continue to hit the like button. We love and appreciate all you guys, and we're going to get to a lot of your guys's, some of you guys' questions. Okay. So what a lot of people, you guys need to understand, the mortgage crisis is okay. There we go. The mortgage crisis is pivotal. It's very important to the overall market, right? So if you were old enough to remember the recession of 2007 through 2009, it was the housing market had a lot to do with it, right? The mortgages, the banks, they worked hand in hand, right? You had adjustable mortgage rates, which is an ARM, right? So I'm gonna let Mo. Man, I am so tongue twisted. Let me bag up. Excuse me for that. You're Curry. All you guys with stock Mo, stock Curry. I was thinking my buddy Josh. I was thinking about stock Josh, and I was like, no, that's too many. So let me bag up. Let's go back. So the housing market, that is funny. The housing market, a lot of people think that it will take 2 to 3 years for that bubble to pop. And that is not so, good people, right? So what happens is, if you have a fixed rate, then your rate is fixed. So if you got a mortgage in 2020, you could have gotten 2.5%. Stock Curry is going to give us the new number, but now a 30-year fixed mortgage my last reading was 5.64. So you're talking about 2.4 to 5.64. That is a huge difference, right? So you're talking a great deal more money for the same house, all right? And then you got the rising prices. You have less stock, which less houses, and you had great demand. That's why the Fed had to raise the interest rates, believe it or not, to curtail the demand. And so, because if prices keep rising, like gas is rising, housing is rising, food is rising, but you're not getting that rise in pay, then it's going to mess everything up, right? Could you explain what an ARM is, Curry?
Sure. Before I get to, just give everybody a little bit of background on me. So,
Mhm.
going back to 2005, 2006, I was working as a mortgage broker, vice president of a mortgage company, and I was heavily involved in all the loans and mortgages that essentially caused the financial crisis. Uh, Left there in 2007, went to go work for Merrill Lynch and later Morgan Stanley. So, I got quite a bit of experience with this. And just to give you a little bit of background on what an ARM is and why people are doing it, an ARM or ARM is an adjustable rate
Rate
mortgage.
mortgage.
And essentially, the way it works is if you take out a 30-year fixed rate, you would have, depending upon where you're at right now, assuming you put 20% down, you got good credit, you'd be at about 5.25%. Now, obviously, anybody that doesn't have perfect credit and doesn't put 20% down is going to pay a higher interest rate. What an ARM does is it allows you to come in at a lower interest rate, say maybe 4.75. But the trick there is that after 1 year, that rate is going to adjust. That's why it's an adjustable rate mortgage. And so what ends up happening, let's say a year from now, the average mortgage is 7.5%. Well, your rate now adjusts from 4.75 to maybe 6.5%. It's always going to be a little bit less than a 30-year fix would be. But the problem is if your rate is jumping 1 or 2%, probably closer to 2 or 3%, honestly, over the course of a year, then your mortgage rate will go up significantly as well. So what's ended up happening is as mortgage rates have gone up and as housing prices have gone up, housing has gotten more and more less affordable. In fact, we are actually at the least affordable housing market since 2007. Actually, July 2006 was the least affordable housing market in the United States in history. And right now, we are this close to having the most unaffordable housing market in the history of the housing market. And so what happens is a lot of people can no longer qualify for mortgages. So what they're doing is they're taking on these alternative mortgages, specifically ARMs or adjustable rate mortgages, so they can get a lower rate right now. But it's really, really bad to do that because a year from now, your mortgage is going to jump significantly. It might jump from, say, $3,000 a month to $3,600 a month or $3,800 a month. And if you could barely qualify at $3,000 a month, there's very little likelihood that your pay from your job is going to increase enough to make up, say, a $3,800 a month mortgage or a $4,000 a month mortgage or whatever it goes up to. And so what this ultimately will end up doing down the road is for the next year, everybody that gets an ARM, it's going to be fine. They'll be able to pay it. They can afford it. Well, a year from now, those ARMs are going to adjust and they're going to go a much higher rate. And all those homes are suddenly going to become unaffordable. People will not be able to pay their mortgages. And then what's going to happen is they're going to just stop paying the mortgage because they can't afford it. Now, in the mortgage industry, it takes about 1 year for a lender to foreclose upon a home. So about a year after they stop paying, they'll end up in a foreclosure. And then we're going to start seeing banks get a whole bunch of houses on their balance sheets. So again, about 1 year from now, we'll start getting people unable to pay. About a year later, they'll be in a foreclosure. So altogether, about 2 years from now, we are going to start seeing a whole lot of foreclosures if people take out a lot of these ARM mortgages like they're doing right now.
That is absolutely correct. So I remember when I bought this house, it was just when the mortgage crisis, before it started. I actually bought this house a year before the mortgage crisis started, right? So what happened was my neighbor house was worth about the same. He had an ARM, right? And his mortgage went up $900 a month. Now, unfortunately, he was cut back on his hours. He worked in the steel mill. So he's working less, and the average household cannot afford an extra $900 a month on top of their mortgage. And so the same thing, they said, hey, get in this. Your credit is not so good, so get in this ARM, right? So they put him in the ARM. But just like when he went, because the whole theory is get in this ARM, raise your credit score, and then after your credit is better, right, Kirby, then you could refi and we can get you in a better rate, fixed, right? Sounds good? Yeah, let me sign. So you sign. And then what happened was when he went to go refi, the worst time to try to refi is during a recession. Nobody's getting approved. And now he's stuck. Comment on that.
Yeah, absolutely. You know, working in the mortgage industry back in 2005, 2006, it's exactly what I saw. So in 2005, everybody was getting homes. Home prices were jumping like crazy. They're going up 20% a year, just like they did last year. Same exact situation. And a lot of people were getting these, you know, huge mortgages, and people that honestly could not qualify. And I knew they couldn't qualify. I mean, they qualified, but I knew they really couldn't afford it. And you're putting them into these homes with a promise of being able to refinance at a 30-year fixed rate mortgage a year later, because, you know, the mortgages, you know, their credit's going to improve because they make their mortgage payments on time and all this stuff. Well, what ended up happening is towards late 2006, the mortgage industry started to dry up, and all of these loan programs that we had for people with mediocre credit went away. They were gone. Yep. And the ARMs went away, the option ARMs went away, the no-fi docs went away, the stated doc loans went away, all went away. And so all we were left with were 30-year fixed for people who had good credit. And a lot of the people we got into these subprime mortgages just did not have that great of a credit. And so what ended up happening is they come back to me in 2006 and they were completely unable to get refinanced. Yep. I mean, believe me, we tried. I was a mortgage broker. We had 70 lenders that we worked with, and not a single one would refinance them. And they were stuck. There was literally nothing we could do. And I tried. I mean, it broke my heart because I knew these people were going to lose their house. And it absolutely tore my heart out. It's actually why I got out of the industry. I just could not be in it anymore. It was tearing me apart. And so, unfortunately, you're right. You're absolutely right, Larry. It's exactly what happens is people just cannot afford it. And it's people get foreclosed. They lose their houses. It's like the worst thing in the world because you already had bad credit. Now you got a foreclosure on your.
Now you got a foreclosure.
It's just awful.
It is.
And the problem, though, you know, it's if you look at rental rates right now, rental rates lag even more than the housing market does. And so rental rates are actually going up faster than mortgage rates are.
Yep.
So, you know, anybody that's watching this channel right now and you don't currently have a home, let's say you're paying rent, now is by far the best time to go buy a house because your rates on your rent will probably go up faster than a mortgage will. At least if you go get a house and get a mortgage, you're going to lock in a mortgage rate at a 30-year fix. Now, do not get an ARM. You will destroy yourself.
Yes,
but if you go and get a 30-year fix.
Say that again. Do not. I'm telling you, I'm not a licensed realtor, but I'm going to tell you right now in this market, if you've ever listened to anybody, listen to this gentleman and listen to me. Do not get an adjustable rate mortgage right now. Go ahead. Sorry.
Yeah, absolutely, because it will destroy you. I guarantee a year from now, you're not going to be able to afford it. So I would get a 30-year fix, whatever it is you can afford. And look, if you're a first-time home buyer, there are programs out there where FHA loans where you can pay 3.5% down. There's VA loans where you can pay 0% down and you get approved no matter pretty much what your credit score is. There are definitely programs for first-time home buyers where at 3.5% down, pretty much, you know, most people can afford that. I mean, it's like probably 2 months worth of rent. All you have to save up. So seriously, I would, if you're able to, even if you got to downsize and get into a smaller house, it is better than being in a situation a year from now where you can no longer afford to pay rent. Believe me, I've been homeless twice. The last thing you want to do is get into a situation where you can't afford to pay your rent and you're homeless on the streets. So take care of your family. Do what you need to do now. I would absolutely recommend that if you are a millennial, a Zoomer, whoever, and you don't currently own a home, go find a townhouse, go find a condo, go find something, anything you can afford, get in a 30-year fixed, and that will lock in your mortgage payment, and then you're guaranteed it's not going to go up.
Yep, absolutely. Absolutely. So, I mean, this is all stuff you need to know because this is one of the indicators of a looming recession, right? The two big indicators of a looming recession is job loss and housing crisis. And, you know, I don't, I've been through 3 recessions, actually 4, but 3 that I can remember solid. Yeah, I know I don't look that old, but um, it it these things come, and some of them happen very quickly. Like right now, we just last month we had 11, what was it, 11.6 unfilled jobs. So you're thinking there's no problem with the job market. There's plenty of jobs. That could flip on a dime. It happens. It happens all of the time because when we're heading to a recession, companies have to operate leaner and they start laying off, right? And so now that 11.6 million unfilled jobs turn into 2.6 unfilled jobs, just like that, because they're downsizing. My wife worked for a company in the hotel industry. I mean, at one time they had 14,000 employees. They had to lay about, I don't know, over 80% of them off. So it could happen really quick, during COVID, but things could happen really quick. So what we want to do is not scare you, but prepare you. Now, I'm going to try a screen save. My tech guy, my brother Rodney Lawrence Jones is not here. He faked me out. No. So I'm going to try a screen share. I want to show you guys something. Let's see. Let's see if we could see this. All right, you guys. Hopefully you can see this. I know, and it looks grainy, but a small cap stock is generally a company with a market capitalization between 300 million and 2 billion. Okay, right? So some people say under 3 billion, just like Stock Curry said. Some people say under 1 billion is a small cap stock, and some stock are small cap, though they may appear to be more. So let's look at BBIG. All right. BBIG, if you go over here to the market cap, BBIG is 573 million. So that's a small cap stock. I'm giving you guys examples that are asking. Okay. Here we go. BitNile, right? Here we go. 79.7 million. So these are absolutely small cap stocks. It's based on the market size and not the price of the stock. Anything to add to that, Curry?
No, I think you hit it spot on. Talking about jobs and layoffs and all that stuff, I'm already seeing a lot of indications of layoffs in the market. We see Netflix laying people off, Carvana, so many startup companies that have now lost their venture funding are also doing layoffs. And what this is causing is obviously whenever you have a recession, the layoffs don't happen all at once. It takes time. It's sort of balloons, right? So you start with a few people getting laid off, and then that causes less buying pressure on travel. So you start getting a few more layoffs in maybe hotels or mortgage. That causes less buying pressure at the supermarket. So you start getting layoffs in places like Walmart, Target, and it balloons as more and more people get laid off. Now, there are 11 million unfilled jobs. However, the layoffs that are occurring right now, those 11 million unfilled jobs will very quickly get filled by the people who are currently getting laid off. Eventually, those jobs are going to run out and they're going to get down to zero. And then at that point, the layoffs are really going to start to affect the economy and really trigger a recession. So if you think about the things that could trigger a recession in the future, you have job loss, which we are already starting to see. And you've got mortgage crisis of some sort of housing crisis with either prices going down or less people buying houses. And we're already starting to see signs of that as well. So two of the biggest causes of a recession are both active at the current time. And there are some people, not a lot, but some people who actually think that the economy right now is in a worse place than it was in 2007, that this year could actually be a worse recession than we had in 2008, because not only do we have layoffs starting and not only do we have a housing crisis on the horizon, but then on top of that, we've also got high inflation and we have rising interest rates. So we actually have 4 things working against us versus in 2008, we only had 2 things working against us. So, again, not to scare anybody, it's to prepare you so that you guys can, start hedging your accounts and thinking about, well, maybe, hold off and just hold some cash and do the things you got to do to start preparing yourself for the possibility of a pending recession.
Yes, I agree. And here's some of the things. So we don't want you guys to leave here scared. We want you to be prepared. This is what I say. If you know that there's 11 million unfilled jobs, there are some of you guys that are just kind of like laying back right now and saying, hey, I don't have to do this, I don't have to do that. But I could tell you guys, now's the time to be going in and taking some of those jobs and creating side hustles. You guys know I'm all about creating side hustles and cashing up, because the problem is going to be, if you've been in the stock market now for, let's say, 2 years, you've been through a cycle where you've been through a correction already, right? And now a crash, and now you're going. So you see these cycles in the last 2 years, right? So hopefully most of you guys know the best thing to do is to have cash to buy during the recession. Hopefully you guys know that right now. So what I'm suggesting is to get one of these 11.5 million unfilled jobs part-time. Work an extra hour on your job. Do something you're good at that someone will pay you for, and just cash up. Just cash up, because you're going to have powder to invest through the bear market, right? And I pray that no one listening to me right now will lose your job during the recession, right? You agree with that?
Oh, absolutely. Pray with that. I would take it a little bit further also and just talk about personal finance a little bit. Layoffs can come at any moment, very unexpectedly. And I would say that everybody should, we all say plan for the worst and hope for the best. So I would say everybody should be holding up cash right now, save up cash, lots of cash, and get that cash saved up in case you do get laid off. You can continue to pay your bills. Now, if you don't get laid off, then when this is all said and done, you can use that cash to go invest in the stock market.
Yep.
But if you do get laid off, at least you have a nest egg available to pay your bills, and you're not running into a situation where you're kicked out on the street and homeless. And the other thing you might want to consider doing, if you get that cash saved up and you're good and you've got plenty of cash to make it a few months, then start using your extra cash to start paying off your credit cards, because credit card rates are going to start going up and they're going to get very expensive. Don't just make your minimum payments, make more than your minimum payments. So I'd say number one is build up a cash savings. Try to get at least 3 months of cash saved up, 6 months if you can. Number two, pay off your personal debt, especially your credit cards. And then if you make it through the recession unscathed and God blesses you and you still have your job and everything works out well, you have a stockpile of cash to go invest in the stock market and to buy at extreme dips when this is all said and done. And man, you are going to be set up to make a ton of money in 2024 or 23 or whenever this stock market rebounds.
Yes. Thanks, Street Guru. Dear, wow, I'm trying to see, why didn't you follow, since the audience will be upset if you never check out. Man, I don't even know what this is. A few weeks ago, you promised you would check out. Oh, Post Chain. Yeah, we did. We ain't talking about it. Stop sending cash, because Street Guru, I appreciate it. Yeah, we're not going to talk about Post Chain right now. I wouldn't get in it. Sorry. And if you work for Post Chain, I'm sorry. So I hope you don't. But a lot of these cryptos are getting interesting ways to try to promote, and I'm not saying that this gentleman is, but Street Guru, I'm not saying that you are, but I kind of looked it over, and it's not something I want to get in a looming recession. So in a looming recession, I'm just going to tell you guys, don't be chasing short squeeze potentials. Don't be chasing hype coins, and this now is absolutely not the time. Now is the time to be looking for solid companies and cashing up and waiting, right? Now's the time to be getting your cash. For those of you that was saying, man, I wish I had some Apple, but all I have is BBIG, AMC, Shibcoin, and that's all I have in my portfolio. I'm just going to give it to you guys real. Now is not the time to chase those stock or crypto, right? Now is the time to look at the stock and crypto that you wish you had in your portfolio, but you wish it was lower. Well, guess what? It's lower, way lower, and it's getting even lower. So now what you want to do is cash up and wait so you can buy Tesla. Me personally, I think at the bottom of the recession, you'll be able to get Tesla in the $500 range. That's just me. That's not Curry talking. That's just me, right? And you'll be able to get Apple and some of these, blue chip companies that have cash like Apple that's not going anywhere, that will trade sideways and come down a little more, but will make you great gains. And these are generational companies, right? Some of the stocks that you guys are in are not generational. Some of the crypto won't even be around in 5 years. So I'm just going to give it to you guys straight. Now is the time to look at the stock or the companies that you wish you had, that you thought were too expensive, or you said, hey, I wish I could have bought it at this price. So now I want you to start writing down those stocks, establishing your positions, and getting ready. What do you say about that?
Absolutely. I mean, when it comes to cryptocurrencies, a lot of people, there's been some misconceptions lately about cryptocurrencies being a store of value, and we're just not seeing that.
Nope.
Cryptocurrencies trade along with the stock market, but they trade exponentially. So if the stock market goes down 10%, crypto might go down 15% or 20%. And right now, it looks like crypto's in a crypto winter. It's very, very bearish. Bitcoin right now looks like it's pretty much going to get down to 19.5, possibly as low as 12.5. So it's definitely going down. And, the other thing a lot of people don't realize, especially if you haven't been investing that long, is 80% of stocks eventually get delisted. Now, some of those are going to get bought out by other companies and merge. Some of those are just going to go out of business. But 80% of stocks eventually get delisted. This is not the time to be investing in speculative plays in these companies that have no cash and no earnings. This is the time to be investing in companies that have loads of cash, that can make it through a recession, that are profitable. And it doesn't have to be both. It doesn't have to be a profitable company with loads of cash. It could be an unprofitable company with a lot of potential, but they have plenty of cash to make it through a recession. Or it could be a company that's very profitable and doesn't have any cash. But the point is, you got to look for these stocks that are going to be able to make it through a recession without having to raise funds. Yes. Because you don't want to be stuck in a company that has to raise funds, because venture capital and angel investing and all the funds are drying up. They're gone. They're going away. That's why we're seeing a lot of layoffs in startups. And so the companies are not going to be able to raise funds. And a lot of those companies are going to be out of business. Yep. So you've really got to be careful about what you're investing in right now and dollar cost averaging into, and really picking some solid companies that have a very high chance of making it through a recession.
Yes. And it's okay to get some of the lower cap stock that may pop, but that needs to be 20% of every dollar spent. It doesn't need to be 50, 70, 100%. You want to keep that under 20%. You want to gamble with that? That's fine. But 80% should be into the solid companies, right? That's what you need. So, and I know some of you guys that are listening to me, somebody sent me their portfolio and it was nothing but garbage. And I was just like, are you kidding me? You don't have, you got on your plate, you got a slice of cake, right? No meat. Like all you got is dessert, and you can't live on that. All right. Thank you.
And you're trying to lose weight.
Say that, and you're trying to lose weight, and you got cake, potato chips, hot dogs, and fries. You go, and you know how y'all do when you do the drive-through, and a Diet Coke. Like that's gonna make it better. So I want to talk about some. Thanks a lot, Street Guru. I'm glad I was able to help you. Thank you. I didn't want to be wrong about it. Hey, let's talk about some stock, because I like to bring gifts to the good people. I want you to talk about some stock that people can keep their eye on, and that is entering into the oversold territory. You got some gifts for us?
Yeah, I'll be honest, I really haven't been buying very much at all. I've
Me either.
been very, very careful. It's only, I think this entire year, there's only been 3 stocks I bought. Well, I take it back. Back in January, I did buy some banking stocks, but I actually got out of those
Yeah,
because
yeah.
the banking stocks, normally when interest rates go up, the banking stocks go up as well because they make more money from their loans. But what we're finding this year
Yep.
is that the inflation is causing wages to go up faster than the rise in profits from loans, meaning that the net profit is actually going down. So banks are getting hurt. I actually got out of all the banking stocks. The 3 that I bought that I'm still holding on to, I did buy a little bit more AMC when we got down to about $10. And I wish I'd bought more because it's doing really well right now.
Right now, yeah.
And the thing about AMC is I have a very small position in that, but
Mhm.
I never underestimate the power of retail investors
Retail
coming
investors.
together collectively. So that's why I bought that one when it got down real low. And then the other 2 that I bought are GLDG, which is a gold company.
Gold.
It's a small cap gold company. They invest in these devalued gold assets around the world. And that one I got because it was down to a pretty strong support level at around $1. And gold typically goes up during high inflation and a recession. You're going to see gold go up. So that's why I bought that one. And
Yep.
then the other one that I bought recently was SoFi, SOFI, because SoFi just got their
Yep.
banking charter and fintech got absolutely demolished.
Demolished.
But SoFi is one of those small cap stocks we've been talking about
Yep.
that's down significantly,
Yep.
that has tremendous profit potential in the future. They
Yes.
got plenty of cash to make it through. Their revenue and earnings are increasing. It's got everything I look for a rebound. And SoFi has been performing beautifully over the past few weeks. And
Yep.
so that is my number one biggest stock that I've been dollar cost averaging into is SoFi. I have been buying more SoFi than anything else. But again, the vast majority of my money remains in cash. There's been very little that I've been buying because I still think stocks are going to fall through October. But since we're already seeing small caps start to go up, even as the overall market goes down, I've been starting to buy into some small cap stocks. And
Mhm.
there are others that I am looking into that I haven't quite pulled the trigger on yet. But those are the 3 that I bought so far. What
Hey,
about you, Larry?
number one, let's do a station break, right? Vintage Girl 99, thank you so much for your donation. She says stock curry advice is on point. And so listen, hey, we need twice the subscribers, man. I mean, we guys are bringing it to you. Let's face it, we're bringing it to you better than CNBC. Okay, we're bringing it to you better than Fox Business. Come on, people. All we need is likes. Like the Beatles song. All we need is love. Come on, show us some love by hitting that like button. All right, let's get these likes up. All right. So listen, after you hit the like button, there you go. Like and subscribe. After you hit the like button, and I'm also going to say this at the end, at the top of my comments, I have Stock Curry's page posted. It is the absolute top comment. I want everyone to go over to Stock Curry's page, hit the like, subscribe, and the notification bell, and click all. Hold that sign up again, Stock Curry. I want you guys to hit the subscribe and then flip it over. Yep, hit that like button on the last video he did and then hit that bell, okay? Because I'm not interested. Let me tell you something. I'm just keeping it real with you guys. I have people with over 1 million subscribers that want to do this with me. I'm more interested in bringing you guys value. And this gentleman offers value. And so I don't care about sharing. I don't see this as a fish tank. I see it as an ocean, right? And so there's an ocean of wealth for us all to go get, and we gonna go get it. Hey, so listen. So you guys heard about the housing market. You see what's happening. You see what's happening in real time. You see what could quickly happen with jobs. So you got the housing market, you got jobs. We know that the yield curve, about the 10 and the 2 year, and you know how that happened already. We got rising inflation, right? And shrinking GDP, right? So explain to the people what will happen if Q2 GDP, which is gross domestic product, if it comes lower and inflation is still rising. Tell the people what that means, Stock Curry.
Right. So if we have 2 quarters in a row of negative GDP, well, let me be more specific. 2 quarters in a row of negative real GDP, that is officially a recession in the United States. Now, I want to clarify that real GDP is defined as GDP minus inflation.
Mm-hmm.
So what we got in Q1, and we're probably going to get it again in Q2, is GDP is going up. So the job market is good. Our gross domestic product is good. Factories are good. But inflation is higher than GDP. So when you do the math and you take GDP minus inflation, it creates a negative, what's called real GDP. And so it's a recession on paper, but most people don't really feel it because job market is still strong. We still got, record unemployment right now. And people aren't really feeling the effects of a recession. I mean, they're definitely feeling the effects of inflation, but you're not really feeling the effects of a recession. So as we end up with negative real GDP, even if the actual GDP is high, that is what's called a paper recession, meaning it's only a recession on paper and it doesn't really affect, company earnings or individuals like you and I. So that is what it looks like we're in right now, is what's called a paper recession. What we're talking about when it comes to the housing market and layoffs and all that, that is a real recession where
Yes.
it really affects real people like you and I, and we really feel it.
Yep.
That, it still looks like it's at least a year off, just based upon how long it's going to take to get through the backflow of unfilled jobs, how long it's going to take for foreclosures to occur. It looks like we're still at least a year off from a real recession.
Yeah.
Even though we could be in a paper recession right now.
Exactly.
We won't know. Now, the other thing that's really important to understand about recessions is we don't know if we're in them until we've already been in them for 7 months.
Boom.
And the reason for that is because it takes 1 month from the end of a quarter before we get the GDP data, and it takes 2 quarters or 6 months of negative GDP before we're officially in a recession. So you got 6 months of negative GDP plus 1 month to wait on the data. All in all, it's 7 months delay from the time we enter a recession until we know we're in a recession. So the good news is once we are officially in a recession, normally the Fed will start lowering interest rates in order to get us out of a recession. Although if history is any indication and what the Fed is saying is any indication, even if we do enter a paper recession, because the economy will still be strong, the Fed is pretty much going to ignore it, and they're just going to keep raising interest rates until it turns into a real recession.
Yes.
So it's just something to watch out for and be careful of. Uncle Larry, if you don't mind, I just want to take a minute and kind of go over a few misconceptions that I've heard a lot of people talk about. So we'll start with mortgages for a second. One thing I've really heard a lot of people say, especially amongst realtors and mortgage lenders, anybody who's kind of into the industry, Yep. I keep hearing them say over and over and over again, yes, mortgage rates are going up. No, I don't think housing prices are going to go down.
Come on, please.
I heard the exact same thing in 2006.
Yes.
Identical. Every single realtor was saying the exact same thing in 2006. Every single mortgage lender in 2006 was telling their customers that housing prices would continue to go up and you can refi and everything's all peachy. It's just not the case. Let me show you something. Housing prices are very simply a supply and demand curve, period. As demand gets below supply, prices are going to come down. Now, the argument that a lot of people make right now is supply is so high that prices are just never going to go down. Well, come on, man, let's get real. The fact is right now that we have mortgage rates that are going up, And I just spoke to my lender who helps me with all my properties. And she told me that she has seen a 30% drop in the number of people applying for mortgages for new loans, a 30% drop. But hold on, it gets worse, because she says also that we have a 30% drop, but here's the really, really bad thing. Now nationwide, it was 12% drop. She personally is seeing a 30% drop. Now, here's the really bad thing. It's where it gets really bad, is new construction. So when it comes to new construction, the way it works is you go out, you get pre-qualified for a loan. Your house will take anywhere from 9 to 12 months to get built.
12
At the
right
end of
now.
Lately, it's been closer to 12 months, sometimes longer, because of supply chain shortages and lumber shortages, all that. So two problems are happening right now. Number one is we have housing building costs that are up 36% year over year. So you end up with a prediction of how much that house is going to cost when you go ahead and sign the contract. And then a year goes by and your house is ready to go. And the final cost is now 36% higher than the rate that you were originally quoted. Problem number two is the fact that the interest rates on mortgages go up. You cannot lock in a mortgage rate until you are 60 days away from closing. So you lock in the mortgage rate, you have to lock it in within 60 days of closing, and then you have to close within 30 days of locking it in. So here's the problem that people run into is right now, people 12 months ago were doing all this new construction. The price of their house is up 36%. Their mortgage rate is doubled, and they can no longer afford the house that they just built. And so we are seeing a huge number of people on new construction side that can no longer afford their houses. In fact, some statistics are coming in showing it could be as many as 80% of new construction homeowners can no longer afford that house when they go to close. And so this is a major, major problem, because it's going to cause a huge supply chain amongst home builders as they try to offload these assets. And keep in mind, banks and home builders, they are not in the housing industry. They're not there to hold on to houses. They are there to construct, and they are there to finance. They are not there to buy and sell houses. So they will try to offload those houses as quickly as possible at whatever discounted rate they have to offload them at. And so they end up offloading them at huge discounts. And then you got that problem that's coming up right now. And then on top of that, my mortgage lender I spoke to earlier today said she's also seeing housing prices start to come down. So as prior we had bidding wars going up through spring, we are no longer getting bidding wars. Those are going away. And then some people are actually lowering their asking price on their housing. And we haven't seen that in over a year, where people actually start lowering the price of housing. So already we are seeing people lower their asking price on their housing. We're seeing bidding wars go away, and we are seeing new construction unable to get sold. And all of this, what is it doing? It's greatly increasing supply, and the number of people who are applying for mortgages for new rates is down anywhere from 12 to 30%. That's greatly lowering demand. As supply goes up and demand goes down, what happens to prices? Economics 101, prices are going to go down. And so absolutely, housing prices will go down. And all these people who are realtors and all these people who are home lenders who are saying the exact same thing they said in 2006, that prices aren't going to go down, they're all going to be proven wrong again, because economics are there. And the other thing I want to say that's a big major misconception is I've heard a lot of people say that this time is different. Look at 2006. In 2006, we had subprime mortgages. We had no-doc loans and state-of-doc loans and option arms and all these things that we don't have anymore.
If you had a pulse, you could get a house. Go ahead.
Yeah, exactly. And so all of these loans are gone. And so we don't have those problems anymore. That's what you keep hearing people say. Well, here's the issue is there's an old saying, right? And the saying is this: the most famous saying on Wall Street is, "This time is different." That's the saying. The most famous saying on Wall Street is, "This time is different." Every single time you go back and you look at history, you can find differences. However, there are enough similarities to where you go back in history, every single bubble eventually pops and prices go down. Every single time PE ratios get above 30, they eventually come back down. Every single time housing becomes extremely unaffordable, it comes back down.
Back down.
So you know what? There are always going to be slight differences from before, but don't fall into the foolish thinking that this time is different,
Nope.
because there is always going to be differences, but there are way more similarities than there are differences. And I tell you what, even though the situation might be slightly different, the results are always the same. So pay attention to history, watch what happened in 2007. Keep in mind, mortgages started drying up in 2006. The stock market didn't start going down until 2008. It took 2 years. Now we are in 2022. Mortgages are starting to dry up. It's going to affect the stock market in a big way in 2024. It's delayed. It takes time, but man, it's going to hit, and it's going to hit hard.
It's going to get hard and quick. It's going
Yes,
to be an elevator drop.
yes. And it's very possible.
Yep.
Yeah, it's very possible that we see something that's happened so many times in history where we get a little bit of a paper recession right now. The stock market goes down through, say, maybe October, and then November, it starts going back up. Through all of 2023, we rise, we get back up to new all-time highs, and then bam, 2024 hits, and we crash again.
Yep.
It's happened before. If you go back and you look at the stock market in 2007, 2008, you're going to notice we got about 2 months of drop. We rose back up, almost hit new all-time highs, and then the market just fell, the bottom just fell out, and it absolutely crashed. It's very, very common to have a major drop like we've had right now. I mean, the NASDAQ is down almost 30% from highs. And then you get this big recovery, and everybody thinks we're going back to all-time highs. We might. And then all of a sudden, the real recession hits, and man, we get destroyed.
Yep.
So just be careful. Hold that cash, dollar cost average in. Don't go loading up on anything.
Don't load up on nothing.
No. And hold a ton of cash in case you get laid off, in case anything bad happens to you. Hold a ton of cash. And if you make it through and everything's great, then that is the time to buy at massively discounted prices and make a ton of money going into 2024, 2025.
Hey, you're dead on. So for those of you at the end of this video, I have 2 companies that I work with. One is Moo. That's where we're simply cashing up. So I have a link below. Deposit $100. They're going to give you some free stuff, right? But we're not doing anything with that. Just little stuff that we're doing with that. But we're mostly just saving that cash, right? With Stocks with Josh, he has a play on Verb, which he's doing well in already. That's short term. But those of you that are following me, we're just cashing up with that, right? And we also know about Webull. They have another promotion going on right now. I want you to click both of those links. They're going to give you a ton of free stuff. We need to cash up. And I'm going to tell you, don't just have all your money in the bank. I'm just going to tell you that. You want to have some money loaded in some of your portfolios and ready to go. And I will also tell you that it is a good time to get into multiple portfolios, because it's all a mindset, right? If you keep going to where you see a ton of red, a lot of you that are listening to me, this is a balanced approach. Refresh your mind, open a new account, and just have cash ready in there. Because what happens is you keep coming. This is psychology. You keep coming and you see the sea of red. And you know what? At some point, you say uncle when you tap out. And that is the worst thing that could happen when the point of entry, we're approaching the point of entry. I always say the camel, the animal, the camel is walking up to you and he's bowing down, allowing you to get on his back. That's what's happening with the stock market. It is walking up to you and it is bowing down. All right. So don't walk away when he bows down, because he's going to rise back up. The stock market always comes back. So a balanced approach right now is to cash up and be ready to dollar cost average. Now, I know some of you guys are going to ask, Larry, what about your $5 a day challenge? That is different. That goes on during a bear market, a bull market, a crash, a correction that we're going to be doing for the next 5 to 10 years, right? That's different. Time in the market always outweighs trying to time the market, right? And so we started it already. We had dips. Some of those portfolios have low cap stocks in there. So Curry can tell you the market could crash down and some of those low cap stock could trade sideways or even go up during a recession, right, Curry?
Yeah, absolutely right. And I want to say something else for your viewers.
Yes.
You know, if you guys don't have a Webull account already, it's only for U.S. residents. So I want to be clear about that.
Yes.
But if you guys don't already have a Webull account, use Larry Jones' link in the description to sign up, because right now they are having their 4-year anniversary and they're having the best promotion in history.
Talk about
right
it.
Now, Webull is giving away 6 free stocks worth up to $12,600. And all you have to do is sign up using Larry Jones' link below and deposit just $1. And Webull will give you 6 free stocks worth up to $12,600. The minimum amount of free stocks you're going to get is worth $34. Bare minimum, $34. It could be as high as $12,600. So absolutely, if you guys don't have Webull, you are missing out on a ton of free money. Use Larry Jones' link below to sign up, because that is just free money that you are giving away if you're not signing up for that. Absolutely. And then the other thing I want to say is, if you have a ton of cash and you know for a fact that you don't need it, you've already got your 3-6 months worth of savings, and you're just holding this cash, planning on buying back in the stock market, maybe 2024, something like that, consider investing in Treasury bonds, but specifically the I bonds, or inflation-backed bonds. Because right now the inflation bonds are paying 9.62% interest. And I don't know of a single other place that will guarantee you a 9.62% interest. If you guys are interested in that, again, it's only for U.S. residents, but you buy those directly from the federal government at treasurydirect.gov. You go to treasurydirect.gov, you can buy I bonds. They pay 9.62% through October. And the only catch, though, there is a catch. You have to hold the I bond for a minimum of 1 year. So that's the only catch to it. But if you know for a fact you got extra cash, you don't need it, you can, don't need it for a year, for sure. You can go buy the I bonds, get 9.62% through October. And they're only good in the U.S. residents, but you got to hold it for 1 year. But by far the best place to earn interest as you're waiting to buy the dip.
Okay, I'm going to say something, and then we're going to end this shortly. I know this is good. Curry, we're just going to have to do this again. So I'm going to say this because I got to talk to people like I'm used to talking to. Listen, y'all, especially y'all that are, and I'm saying y'all, not you all. I'm from Chicago. We say ask and not ask. So I'm talking in my own language. Listen, good people. Let me tell you, here in the Midwest, in the Chicagoland area, it gets 30 below zero wind chill, right? So in the summertime, you ever been downtown, you see them girls in party dresses. So that's what's sexy to these young guys, right? But now it's 30 below zero, it's 2 feet of snow, and you see a big girl with a big Parker coat on, a scarf and a hat. That's what's sexy when it's 30 below zero, right? So I'm making a comparison. Those are the stock you want to look at right now. You want to look at bonds. You want to look at the boring stock. If you were stuck on an island and it was 30 below zero, and you needed to get warm, you're not going to be with the little skinny girl with the little short dress and it's 30 below zero. You're going to be finding, somebody with a little meat on their bone. My dad used to say, even a dog want a little meat on their bone. I love it and respect all of you, all shapes and sizes. But I'm just doing this to have a little fun, to say, look for the stock that is you may think is boring, but there's safety in bonds right now. Like he's just telling you guys, if things are going down, you want to go into safety, right? You want to look for value right now. And so you gotta have a plan. And if you don't have a plan, then you plan to fail, right? So I agree with you. Let's look for things that you're really not into, like metals and stuff that are going to hold good or go up during a recession. There's always money to be made. You just have to know about rotation. I want everybody to Google rotation with stocks. And I want you to visit that because you will know how to rotate season after season. You will know how to rotate in a bear market, a bull market. And once you understand these rotations, and I know right now, Stock Curry, he's been doing options. He's been riding the market down. He ride them up and he ride them down, right? And so though the market is coming down, he's making money on the market coming down, right?
Yes, I
and
am.
then when it turns around, he makes money on the market going up. And you could do that with options, okay? And so there's a lot that we're going to be discussing. I just got to have you back, Curry. This has been great. Any more gems you want to leave with the people?
Man, I think you covered it all great. I'm just going to play off of your little analogy there and say, if you're going after those hot, sexy stocks that everybody on Wall Street Bets is talking about and Twitter, and man, that little skinny girl, she's going to be cold. She's going to ask for your coat, and she's going to leave you freezing to death in 30 below temperatures, and you're going to wish you had never touched her. So you go get with that,
the girl with the big Parker coat on.
That's right. Go get with that girl who already got her coat so you can keep your coat too.
Right. Get with the guy with the big Parker coat on and not a windbreaker, 30 below zero.
Yes, because you ask anybody who's wealthy, anybody who's a millionaire, and they're going to tell you that making money is great. But in times like this, the number one thing everybody is focused on is not making money. It is maintaining their wealth. They're just trying to not lose money. This is a very difficult time to make money. This is the time to hold on to your wealth. You ask anybody that makes their first million, and they will tell you that it's easy to make $1 million. It's very hard to hold on to it. That's right. So this is the time where you have to be holding on to your wealth and maintaining it. This is not the time to go jump into speculative stocks and be losing money because you got FOMO and you got greedy. This is not the time to be greedy. This is the time to be storing up on gold and metals and bonds and all those safe investments. They may not go up, but at least they're not going to go down. And that's the key.
That's it. You know what? I'm going to piggyback to the housing market. I will tell you guys that I was ready to buy a house and build a new house, my forever house, right? So I was going to spend a lot of money, right? My forever house. And when I saw months ago where the housing market is headed, just like Stock Curry said, I'm going to tell you guys how I do. I'm driving around in the subdivisions that I want to buy from. But I know in months that I will be able to come there and get a new build, empty house that someone couldn't afford to close the mortgage on. And all I have to do right now is cash up. So that's why I'm waiting, good people. I'm shooting it to you straight. Cash will be king. And so these builders will have all of this supply. It goes from no supply to too much supply. The banks want to get rid of them, and they're going to be saying, let's make a deal. It happens every time. And realtors out there, just like you said, are just singing the same song that they sung in 2008. I've heard the song. I've saw the show. I know how it ends. I got the t-shirt. Right? But he's telling you, Stock Curry is hitting you with all kind of truths. So I want you guys to rewind any segment that you want and just go back and listen. I sign off on everything he said. He is absolutely knocking it out of the park. And who better to tell you than someone that was working for the mortgage banks, you're getting it from the horse's mouth, so to speak. For those of you that don't know, that's a term. I'm not calling him a horse. All right. So listen, everybody, we're at 1.8 likes before we sign off. Can we get it up to 2,000 likes? Let's get it up. Everybody, if that like button is not dark black, then it is not. Thank you. Hit that like button because it helps the algorithm. We want to get this information out to the masses. All right. I'm going to be signing off, but before I sign off, you see and hear how smart Stock Curry is, right? I'm begging you for your pocket's sake to go over, and he's not paying me for this. He didn't ask me. I reached out to him. I'm telling you guys to go and subscribe to Stock Curry. I have his link at the absolute top. I have his link, and then the next link is Weeble, and then the next link is Mumu. Those top 3 links, I want everyone to click, right? So number 1, click, hit Stock Curry, hit like, subscribe. Number 2, come back, download Weeble, and you heard about the promotion. You can get 34 free dollars. Was it $36 by depositing $1 up to how much? Say that promotion one more time.
$34 minimum, $12,600 maximum. And all you got to do is open an account, deposit $1. And the trick is, though, make sure you claim your free stocks. You got to claim them within 30 days. So people forget to claim them. Yes. So yeah, claim your free stocks in the app. But yeah, anywhere from $34 minimum to $12,600 maximum.
That's it. And let's go over there. I'm gonna go over there, fam. Meet me over there at Stock Curry's page, man. I'm gonna be looking to see if the fam is over there, cause this is what we need. We need good guys to rise to the top with real information. We don't need somebody, that don't know what they're talking about, screaming buy every day. We need guys. That's why I partner with Stock Mo. That's why I partner with Keenan Grace. That's why I'm partnering with Stock Curry. That's why I partner with Stocks with Josh. One day I'm gonna have all these gentlemen on. We're gonna have boxes everywhere. All right. So I'm gonna leave it right there, man. This has been great. And hey, thank you for coming on and being a part. And anything I can do to help the people, that's what I'm going to do. Hey, we got 2,000 likes. All right. Remember those 3 links, good people. Live, love, laugh, and learn. We'll see you later. God bless.